Hello, everyone, and thanks for joining me for our Q2 2025 model portfolio commentary. I'm Sam DeNorma, and in this brief update, I'll walk through key market developments over the past quarter, review model portfolio performance, and share insights to help guide your client conversations. Let's jump right in. The second quarter was defined by a few dominant themes, most notably the volatility stemming from tariffs and geopolitical friction. The initial imposition of tariffs, followed by a quick reversal, led to a steep market correction, but in classic fashion, that was followed by a V-shaped recovery. We also saw a growing number of large companies pulling back or refusing to reaffirm forward guidance, citing continued economic uncertainty. And interestingly, despite this uncertainty, capital investment in artificial intelligence remained a bright spot, strong and accelerating. Turning to performance. Here you can see the results for our core model portfolios across the 3-month, year-to-date, and 1-year periods. Overall, performance was within expectations, reflecting the discipline of diversified allocations and rebalancing. Looking under the hood, let's talk contributors and detractors. On the positive side, international outperformed the US, with SPDW returning 18.6% versus VOO at 10.9% year-to-date. Gold remains strong, with GLD returning 26% year-to-date. In our dividend growth model, our best performers were JP Morgan, L3 Harris, and Microsoft, returning 22.4%, 20.5%, and 18.5% year-to-date, respectively. Taxable bonds outperformed munis, with BIV returning 5.2% compared to NYF's negative 0.8%. On the flip side, small caps lagged, with VB returning negative 0.6% year-to-date. In the dividend growth model, Booz Allen Hamilton, Eli Lilly, and Qualcomm lagged, returning negative 18.3%, positive 1.4%, and 4.9% respectively. Aside from munis, we saw long-term bonds underperforming, with BLV returning 2% less than the intermediate term BIV. Looking forward, there are several evolving storylines worth watching. First, the large tax and spending proposal aims to permanently extend many of the TCJA provisions. Whether or not it passes and how it's paid for could have broad implications for markets and planning strategies. The Federal Reserve, meanwhile, continues its wait-and-see posture. As noted in their May meeting, they remain cautious, citing the need for further clarity on inflation and growth before acting. And we can't ignore geopolitical developments, particularly around tariffs. The recent rollback is temporary, and markets will be watching closely when that 90-day period ends. With the sharp rebound in markets, now is a great time to revisit client positioning. Check in on risk tolerance and target allocation is always wise after a volatile period. For clients with short-term spending needs, this could be an ideal opportunity to raise cash while values are elevated. And with interest rates staying elevated, a liability review may reveal planning opportunities, especially around debt management and cash flow planning. As always, we appreciate the trust you place in us and the work you do for your clients. At Brighton Securities, we're here not just as advisors, but as partners in helping clients reach their goals through all of life's seasons. Thank you again for watching, and as always, don't hesitate to reach out with questions or for help preparing your next client conversations.